Welcome back to All Things Money. I'm David Blain, and during today's show we're talking about the stock market and the global economy, and will this upward trend continue, or has the recent decline in the market signal the negative for the future? When we finished up, we were talking about recently on our friends at Ned Davis Research. Their crowd sentiment poll had reached a short-term pessimistic trough. And we want to spend a minute or two talking about this sentiment poll because it's one of my favorite indicators. What they do, it helps measure what we call the crowd psychology. And we all like to think that, markets are perfect and you have all these rational participants, buying and holding for the long term. Well, the reality is in the short term, all markets are driven by crowd psychology. You can see it from stocks and bonds to consumer products. I mean, look at the new iPad, the crowd psychology, people rushing to pay a very extreme price for it. Or the iPhone, the price of the iPhone is much lower than it was several years ago. And so you see these crowd psychology, people rushing into whether consumer products or it could be stocks or bonds. And so it's very important to get a handle on crowd psychology. And Ned Davis Research does an excellent job of this. They look at Investors Intelligence, which is a survey of stock market newsletter writers, the American Association of Individual Investors, which is market expectation of individuals, the CBOE put-call ratio, which is a measure of call options to total options traded on the Chicago Board Options Exchange, and this measures optimism or pessimism. Ridex funds assets, they were, long before they were ETFs, Ridex funds had a series of bearish funds, and so we look at a lot of people use Ridex funds for short-term timing. We look at the Commodity Advisors Daily Sentiment and some other sentiment indicators, and we look at the aggregate percentage of investors in the market that are either bullish or bearish, and this gives us a good indication of where the market participants are. These are not designed to be absolute buy and sell signals, but when the sentiment of the market reaches a peak or a trough, it usually pays at this point to reverse and go contrary. So what we say is go with the flow until sentiment reaches a peak and then starts to reverse, and then you want to be contrarian. And so we find these very useful for helping determine short and intermediate term peaks in the market. Next, we're going to move to some of our earnings indicators. We're looking at a very favorable earnings environment for the S&P earnings. We've moved up to 83% of our earnings model are now in positive territory, which typically has led to a 19% gain per annum in the S&P 500. This model takes a look at the earnings environment for the stock market and the composite companies in the market and gives us a good indication of earnings. And so earnings are certainly recovering at a nice pace for the corporate America. We look at the economic environment. We use the Ned Davis Research Economic Timing Model, which recently has moved into the its highest level of economic expansion, which typically has led to a stock market gains of over 17% per annum. It reached a very negative trough late last year and has since almost gone up in a straight line. And so this indicator has about 27 economic variables in it, and it shows very robust growth in the United States. Once again, we know that the employment numbers have not kept up with this, but overall the economy has been recovering very significantly. Weakness still probably in housing and some other things, but it was so bad it couldn't help but get better. And so typically when markets go up in this fashion, it's a positive sign for the stock market. We also have a very favorable interest rate environment. Typically when you see low interest rates, it's very positive for for the stock market. Looking at a 3-month composite yield from the U.S., U.K., Canada, Switzerland, and Euro, we see that short-term interest rates are still hovering extremely low. More importantly than the actual level of rates is we look at what's called the yield curve, and we look at the difference between short-term and long-term rates. And we classify the yield curve as either steep, flattening, or inverted. And a steep yield curve means that you have very low short-term rates and very high long-term rates, and so the yield curve is very steep. A flat yield curve means that there's not much difference between short and long-term rates. And an inverted yield curve means that you can make more money on, say, a 1-year bond than you can a 10-year bond. And so when we have a steep yield curve, as we have now, meaning that your short-term interest rates are lower than your long-term interest rates, it's very positive for the stock market. Our indicators also indicate that short-term interest rates are very good for small-cap stocks. Finally, we'll be keeping a close eye on equity movements in China and other emerging markets, resource sectors, and the commodity index. These are themes that we've been following for several years now. We look at the ratio of China's outperformance or underperformance to the rest of the world, emerging markets versus the rest of the world, global basic resources versus non-commodities, as well as the commodity index itself. And all these appear to be on the rise once again. Well, that takes us to our next break. When we get back, we'll answer a few questions from our listeners and viewers. For All Things Money, this is David Blain.